So in this video, I'm going to do a little bit of a breakdown about Uber and whether or not 2025 could actually be a good year to buy their stock. Now, before I get into this, none of this is financial advice. This is more of a breakdown of how I'm looking at it as someone who's been interested in Uber stock for a while. One thing to keep in mind here is obviously it's been an up and down year for a lot of stocks all year long because of all the tariff news and deals being made, deals not being made, up and down things being posted on Twitter, news constantly coming out causing the market to go up or down. So despite all of this, let's look at some of the numbers. So Uber's up 1.78% today. In the last 5 days, they're up 4.7%. Many stocks are having a rally these last couple of months because of the tariff talk is subsiding a little bit, although there is still that looming threat of what tariffs could do to a lot of things. Uber might not be hit as hard as many other companies, though. They are actually doing pretty well in the last 6 months. They're actually up 32.52%. Year to date, they're up 44.43%. So they're actually one of the few tech stocks that's really doing well despite all of the tariff news being up and down all the time. Now, over the past year, they are actually up 27%. So obviously a little bit up and down, but they are actually gaining some momentum this year despite everything that's been going on. And they actually have a 170% return over the past 5 years. Now, some other things to keep in mind, they don't offer a dividend yield. So this is strictly, you're looking at this as a growth stock. So you're looking to get the maximum return possible because you're not getting any sort of dividend. So this might be best for people who are looking to grow their portfolio long term. And if you're, say, trying to live off of retirement funds, you might want to think more about dividend stocks. But obviously that's a subject for another video. Their PE ratio is very good. If you look at just averages, most people might tell you if they make stock videos and stuff or they advise people about stocks, they say something like 20 or so or less. Generally, it could be different depending on who you ask, that 20 to 30 PE ratio or lower. But you have to also look at the industry that it's in. That's not just really a end-all be-all. But either way, no matter what industry, 15.19 PE ratio is pretty low and generally a good sign of this could possibly be a good investment. Now, obviously, two of the main things that Uber is known for is, one, their ride service. So two of the main things they're known for is their ride service, of course, which is just their Uber app, where they basically made taxis obsolete. We all pretty much know what that is. And Uber Eats, you probably know what Uber Eats is. It's basically one of the companies or one of the services that started the boom in delivering food to people's doorsteps from their favorite restaurants. So Uber dominates both of those. Obviously, there are competitors. Like with Uber, you have Lyft. And then with Uber Eats, you have things like DoorDash. If you look at their revenue, their net income, net profit margin, everything's looking pretty good with their year-to-year change. And if you look at their growth versus the PE ratio, which is another thing that some investors might tell you, that the PE ratio is more relevant to the growth or relevant to the return you're getting. There's a lot of ways to look at that, but just to give you kind of a simplified version, if you look at this stock, how it's doing, say, for instance, in the past year, 27% return in the last year. Yeah, sure, there are plenty of tech companies that probably have done better than that, but look at their PE ratio. They're getting you 27% in the past year, and they have a really low PE ratio, so that's good. Well, how are they doing the last 5 years? Their last 5 years, great. If you divide 170 by 5, you're getting over 30% per year in a average return, with, again, a PE ratio that's just 15.19. So whether you want to look at the last 5 years, the last year, even year to date, the last 6 months, you're getting a great return relative to the PE ratio. Another thing I like to look at is how well the company seems to be run. And one of the, people will speculate on that all the time, or people might do an interview with the CEO, but people will not know how well a company is run better than the people who actually work there, the employees. That's why I like to look at Indeed and Glassdoor ratings for a company, because you're getting reviews from their actual employees. 3.8 out of 5 stars is a relatively good number in general. Anything close to around 4 stars means they seem to be well liked by the people that work there. If you look at how many recommend working here to a friend, you have almost 3/4 of their employees recommending working here to a friend. And also the CEO. Very important to have good CEO approval, because they're the ones in charge making the big decisions. Well, their CEO has a 75% approval rating from their employees. So good employee reviews all the way around. Seem to be a good company from the inside out. They are well run according to their employees. And another interesting thing that I noticed was that hedge funds seem to be buying into Uber quite a bit this year. In Q1 of 2025, 77% or 34.6 million shares bought into Uber, while only 10.1 million shares were sold. So you have about 3/4 of hedge fund managers buying Uber versus selling, which could be a good sign, because hedge fund managers, of course, are the ones who are in charge of their clients' money and not just theirs. They have to make good decisions. Hedge fund managers are some of the best traders in the business. So that's a good sign as well, that they are bullish on Uber stock. You also might be interested in looking at analyst ratings in general. Robinhood, one other thing I like about them is they have a overall rating system for a group of analysts instead of just taking it all from one analyst who might be biased. So you have an 81% buy rating. It's actually 81.5% out of 54 stock analysts. You have 18.5% of them saying to hold, and only literally 0% of these analysts are saying you should sell right now. One thing that concerned me about Uber is whether or not they're going to get passed up by self-driving cars, because they are still reliant mostly on people actually driving these cars and then you paying them for their services, whether they're taking you somewhere or whether they are delivering your food. So with these, they started kind of creating a fleet of self-driving cars, but now it looks like they realize the writing on the wall that they are going to have a hard time competing with Waymo, which is actually owned by Google. And Waymo, by all accounts that I've seen so far, seems to be in the lead in terms of self-driving technology. They are testing in many major cities now, and they are probably going to be the one that wins that race, or until further notice. Also, Tesla is trying to get into that, but they're under a lot of turmoil if you saw my last video. But Uber is actually in partnerships with Waymo, allowing riders to book autonomous vehicles in certain areas. So instead of directly trying to compete with Waymo, they are actually partnering with them, which may be a better strategy long term. They said they were developing their own self-driving cars, but they actually sold their fleet to a company called Aurora. And again, they created a partnership with Waymo instead. So the main thing they earn from, of course, as I mentioned, is from their main Uber service, where they help take people from point A to point B, kind of like a taxi service. And then you have food delivery and things like that. And I believe they branched out into other goods other than just food. But you have their commissions. They're earning commissions with every one of those orders. And they're also helping stimulate the economy by helping other people create side hustles where they can make extra money being a driver. And they are pretty much the gold standard for these industries of basically taking people from point A to point B, or from getting to a restaurant and delivering people's food to their doorstep. You can obviously talk about Lyft, but Lyft, by all accounts, doesn't seem to have as many users as Uber. But then you also have DoorDash, which is a big competitor to Uber Eats. But Uber Eats is doing just fine. So I was wondering if Waymo could make Uber obsolete. But the thing is, because they are partnering and not trying to compete with them directly, with robo-taxi services like Waymo, then they may actually be just fine. You could make the argument that robo-taxis will make Uber and Uber Eats obsolete, but they are actually partnering with the leading robo-taxi service, which is Waymo right now, which may help them survive. We don't know exactly what that's going to look like yet, but again, if you are trying to figure out, well, should I invest in Uber long term? Everything looks good right now, and I think for the near future. The question is, long term, will they be replaced by something like Waymo? Will Waymo come up with their own service that makes it where they don't need Uber anymore? They are also a fully profitable company. They first went fully profitable in 2023. I typically stay away from investing in companies that are not profitable yet. That's just something I do. It's not necessarily saying you should do one or the other. Again, I'm not here to give you financial advice. I don't know your specific situation, but I'm very picky on what I buy stock in, and I just stay away from the ones that aren't profitable. But becoming profitable in 2023 made me start to kind of check in on them more often and look and see how they were doing. Another thing, a pretty major celebrity in the hedge fund world, Bill Ackman of Pershing Square Capital Management, actually put quite a bit into Uber as well as Amazon and a few others. According to this report, their top holdings for Q1 of 2025, they have $2.2 billion, or about 18.5% of their portfolio in Uber Technologies. Again, this is a big deal from someone who obviously makes people money for a living by managing their funds, managing other rich people's funds. So Bill Ackman, being a billionaire hedge fund manager, a pretty well-known one, a very successful one at that, putting 18.5% of his portfolio into Uber for his capital management company. That's a big endorsement for Uber. And if you're wondering how successful he has been as a hedge fund manager, he's actually worth $9.3 billion according to Forbes in 2025. So as I said, the case for Uber is kind of what I've been showing you throughout the video. Their numbers are great, their PE ratio is low, their return is really good in the last 5 years, the past year, year to date, the past few months. They're basically leading two major markets in food delivery as well as ride sharing, or kind of like a taxi service. They're doing really well, and they're also branching out in more countries around the world. The only thing that would make me kind of scared of them, if you were to wonder, well, if there's something you might want to do more research into, is the whole Waymo situation. How successful is Waymo going to be? When is that going to become mainstream? Are they going to keep a partnership with Waymo, that being Uber? And will Waymo create a service, maybe through Google, that makes Uber obsolete at some point in the future? That's one of the biggest questions of like the potential downside here. But as somebody who actually owns a little bit of stock in Uber, not much, not a big percentage of my portfolio, I actually do plan on holding them for a long time. Again, I can't tell you what to do in your situation though.